Warren Buffett is widely regarded as the foremost investor in history, and annually, following his Berkshire conference, there's a significant increase in scrutiny, analyzing each utterance he makes during the event. This year, the focus was unmistakably on Berkshire's enormous cash reserve and its potential implications for the overall economy. To many observers, these developments imply that Warren is subtly suggesting a major economic downturn is on the horizon for the United States, and this accumulation is in preparation for it. It's a reasonable assumption that when an investor is reluctant to utilize their cash reserves, they view the market as devoid of appealing investments. With Berkshire Hathaway's cash reserves swelling to $189 billion, many are pondering if Warren Buffett views the entire market as a grossly inflated bubble, especially with 500 firms listed in the S&P alone. The failure to find adequate investment targets raises concern. An accompanying chart demonstrates the extraordinary size of this war chest. A common explanation cited for this growth is the allure of current cash yields. When Warren Buffett refers to his $189 billion cash position, it's crucial to note that it's not actual cash, but rather cash equivalents in the form of short-term U.S. Treasuries. Although this may seem confusing, it means his holdings are yielding returns. The current 3-month U.S. Treasury yield is around 5.4%, making it a highly attractive, guaranteed investment. However, Buffett clarified this misunderstanding during this year's conference, emphasizing that even if the yield were as low as 1%, he would maintain the same level of cash reserves. This stance is echoed by Buffett in a subsequent clip. Listen here to Johan Halen, who questions why Buffett is holding $168 billion in cash, which today exceeds $182 billion, asking what Buffett is waiting for and why not deploy some of it.
This question's from Johan Halen, who writes, "You're sitting on $168 billion of cash, which you told us today is now more than $182 billion. His questions are, 1, what is Buffett waiting for? And 2, why not at least deploy some of it?"
Well, I think that's pretty easy to answer. I don't think anybody sitting at this table has any idea of how to use it effectively, and therefore we don't use it, and we don't use it now at 5.4%, but we wouldn't use it if it was at 1%. Don't tell the Federal Reserve that.
Buffett's response is straightforward. He and his team at the table don't see an effective way to utilize it. Hence, the non-utilization, irrespective of the 5.4% yield, and even if it dropped to 1%. Don't tell the Federal Reserve that, he joked. If yield isn't his focus and he genuinely sees no viable way to invest the money, the logical conclusion is that he perceives the current market as significantly overvalued, and inevitably, if it's overvalued, it must crash to become undervalued. This sentiment, widely shared and inferred from his actions, is that Warren Buffett is anticipating a crash. While he is cautious about acknowledging this, it's quite apparent he foresees challenging times ahead. In 2001, Warren Buffett introduced his own indicator to evaluate the overall valuation of the U.S. equity markets, now known as the Buffett Indicator. This tool compares U.S. GDP to the total market capitalization of publicly traded companies in the U.S., assessing the nation's economic output against the collective value of its public companies. When there's a significant deviation between the two, it's clearly indicated on the graph. Buffett himself has described it as perhaps the best single measure of where valuations stand at any given moment. Currently, the Buffett indicator is at 199%, indicating that the U.S. markets are substantially overvalued, nearly 2 standard deviations above historical norms. Historically, Whenever this ratio has soared to such heights, the market has experienced severe downturns. Unlike other financial experts, Warren Buffett and Berkshire Hathaway do not attempt to predict recession. They openly admit their uncertainty about their timing. However, their strategy is straightforward. They excel at identifying when assets are overpriced, knowing market forces will eventually balance these disparities, creating opportunities. Warren understands that while the timing and location of these corrections are uncertain, the current situation is atypical and likely to shift quickly. At the end of the previously mentioned clip, he shares insights that put everything into context. Listen here.
You know, it isn't like I'm got a hunger strike or something like that going on. It's just that things aren't attractive, and there's certain ways that can change, and we'll see whether they do.
He explains that it's not as if he's on a hunger strike or anything. Rather, it's simply that the market isn't appealing, and there are certain ways this can change, which we will observe. Reading between the lines, it's evident what he means. By nearly every standard measure available, stocks are critically overvalued, and one doesn't need to look solely at the Buffett indicator to see this. For instance, the 10-2 Treasury yield, a metric that has predicted nearly every recession for the past 50 years, has now been inverted for over 630 days, surpassing the record set in 1978. When the 10-2 curve inverts, it's a classic indication that a recession might be imminent, occurring when short-term bonds yield more than long-term ones, a signal that investors expect short-term economic struggles, thus demanding higher returns quickly. On the flip side, they anticipate improvements in the long run, hence accepting lower returns on long-term investments. Currently, 2 chart remains below zero, indicating it's still inverted. Historically, this is a negative sign. However, it's not until this line rises above zero and stops being inverted that we typically witness a recession. Right now, there are no definite signs that this will occur soon, but given that we've just broken the record for the longest duration of inversion, it's plausible to suspect a recession could arrive sooner rather than later. Many Berkshire investors are aware that Warren will never explicitly express bearish sentiments, as he understands the challenge of precisely predicting recession timings. However, most investors can discern the underlying tones in his statements and recognize when he harbors bearish views about the market, such as now. In fact, according to Bill Smead, Chief Investment Officer at Smead Capital Management, this is the most bearish Warren has ever been. Listen to this CNBC interview clip where he offers his controversial analysis, discussing their substantial cash reserve of approximately $180 billion, heading toward $200 billion, and debating what they should do with it.
Fully in charge here. So let's talk about their big cash pile, $180-some billion, heading to $200 billion. What should they do with it? There is some discussion. Would you, as a shareholder, like to see them pay a dividend? Or would you like to see them make a big acquisition? Or would you like to see them buy back shares?
We have no interest in the dividend. It's fine to have them buy back shares, but you always have to think about Berkshire Hathaway, do as I do, not as I say. Because Warren Buffett is a super nice guy, and he has absolutely no interest in offending people. But if you look at what he's doing, he is as bearish as he ever gets. I read right between the lines, right from the beginning at the meeting on Saturday. I was there sitting in the audience, and I thought, okay, huge cash position, trimmed his Apple position. He's nibbling on something below the surface they haven't announced yet. But basically, he is waiting until the next 40% decline in the stock market to apply massive amounts of capital at bargain prices in things that are large enough to be meaningful to this company at the size it is now.
So you just used the phrase, this is as bearish, I believe you said, as I have ever seen him. Is that really the right characterization, or is it rather that he thinks the market is too highly priced for him to go in a big way and put fresh capital to work? In other words, is it so much a
Oh,
bearish call as it is a rejection of the idea that this is an opportunistic time to invest?
Tyler, you have asked a great question. So I'm going to answer this in kind of an odd way. In 1969, he pivoted from being primarily a quantitative Ben Graham value guy to being more of a Charlie Munger qualitative guy, right? Get a reasonable price on a great company. And he said back in 67, 68, 69 that the quantitative ideas that he used to like to buy were combed and recombed. That was his letter to partners. And this last year, he said that the kind of things that we would like to do have been endlessly picked over. So that is code for we think the market's expensive. We're not in any hurry. We're going to wait. And remember, he's talked constantly for 10 to 15 years that the bigger Berkshire gets, the more it limits their opportunities.
Right.
So really, to have very large opportunities for large deployments of that $200 billion, you've got to have the entire market get into very difficult circumstances.
As a shareholder, would you prefer they pay a dividend, make a significant acquisition, or buy back shares? We have no interest in a dividend. It's acceptable for them to repurchase shares, but you always have to consider what Berkshire Hathaway does. Follow their actions, not just their words. Warren Buffett is an exceptionally kind individual who avoids causing offense, but if you observe his actions, he is as bearish as he gets. I realized this right from the start at the meeting on Saturday. I was there in the audience thinking, okay, he has a huge cash position, he's trimmed his Apple position, and he's likely exploring something substantial yet unannounced beneath the surface. Essentially, he is biding his time until the next 40% market downturn to deploy massive amounts of capital at bargain prices in ventures large enough to significantly impact the company at its current size. You just used the phrase, "This is as bearish as I have ever seen him." Is that the correct characterization, or does he simply think the market is too highly priced for him to make substantial investments at this time? In other words, is it not so much a bearish forecast as it is a rejection of the current market conditions as opportune for investment? Tyler, you've posed an excellent question, so I'll answer this in a somewhat unusual way. In 1969, he shifted from being primarily a quantitative Ben Graham value-focused investor to adopting more of a Charlie Munger qualitative approach, securing a reasonable price on an exceptional company. He mentioned back in 67, 68, 69 that the quantitative strategies he favored were overexploited, as he noted in his letter to partners. And this past year, he stated that the types of investments they'd prefer have been thoroughly picked over, which is a subtle way of saying they believe the market is costly and they are in no rush to invest. Remember, he has consistently mentioned over the last 10 to 15 years that the larger Berkshire becomes, the more it limits their opportunities. To truly capitalize on very large opportunities for substantial capital deployment from that $200 billion, the entire market must face severe challenges. There are numerous indications that Warren might be anticipating a recession soon, but of course, this remains speculative based on his actions, or in this case, his lack of action. The Berkshire cash pile has grown excessively, and it's evident based on indicators like the Buffett indicator that stocks are indeed critically overvalued. Historically, the only thing that has made them valuable again was an economic recession. Based on metrics like the 10-2 yield curve, it's arguable that concerning data points hint at potential troubles ahead. Thank you for watching, and as always, please make sure to hit that like and subscribe button if you enjoyed this, and let me know your thoughts on the market's future in the comments below.